Hello everyone, and welcome to this webinar with General Index and Sparta. Your presenters today are Phillip Jones-Lux, gasoline commodity owner at Sparta, and Saket Vemprala, MD for Europe and Africa markets at General Index. I'll shortly hand you over to Phillip and Saket, but before I do, some housekeeping items. First, this webinar is being recorded and will be made available for you after the event. Second, we will be holding a question and answer session after the webinar. However, please feel free to ask any questions during the webinar by using the Q&A function at the bottom of your screens. Now, without further ado, I'll hand you over to Phillip.
Thank you, Andy. So I'm going to start today's webinar essentially from our side with a quick look back at 2024, and then as we move through the winter now, having a look towards what has shaped the market so far in 2024 and what we expect for 2025. So as we have here, our 2024 lessons. The chart on the right-hand side is showing us our kind of rolling front month EPOB spreads, so a measure of physical strength in the European gasoline market. And the summer Atlantic Basin market in general saw one of its softest levels in recent years. 2023 and 2022 were obviously very strong periods. So that was something which struggled to be repeated through 2024. That being said, it wasn't through a lack of export opportunities for Europe. We can see that Europe was able to maintain roughly equal levels of TA movements, even though it was maybe more naphtha than finished gasoline at times. And the flow to WAF was also maintained through much of 2024. Additionally, the encroachment of barrels out of the Arab Gulf and the Middle East, which had been a threat more through 2023, didn't materialize into the Atlantic Basin in such great volumes through 2024, with an apparently tighter east of Suez balance helping to keep those barrels in the east. Now, we can see from this chart here that as I mentioned, ARA gasoline exports were able to maintain a roughly equal level through 2024 versus 2023. Interestingly, though, the first few months of 2024, and again in recent weeks, saw a strong pull to the east, which is, again, slightly counter to what we'd seen in previous years, but that has helped to prop up ARA component premiums versus and in turn then EBOB pricing in recent weeks. So to kind of drill down onto that pull to the east, sorry, let's go back. Drilling down onto that pull to the east, we have some extracts on the right here from our gasoline blender, specifically for the European gasoline blender. And the interesting thing to note here is that a lot of these destinations, which are now pointing to Europe for their resupply for by now early January or January resupply, are heavy takers of E5 oxy barges. So we can see Saudi Arabia 95 RON, for example, at current levels would take up to 40% of these E5 barges. Similar with Pakistan and Indonesia. So this is this can have an outsized impact on barge markets. And similarly, we can see at the bottom of each of these, at current barge levels, we would expect these blends to take the maximum that we would allow them to take in these blends of premium 10 ppm barges. Those barges, just as a side note, are or can also be seen as a proxy for WAF buying. So when premiums spike on these, it tends to be around the time that WAF buying is finalized. Looking quickly at E5 to E10 dynamics, the chart on the top right here is essentially showing our blend costs, our calculated blend costs in ARA for blending E5 versus E10. And we can see that when, and the line at the top there is the gasoline versus naphtha spread. And we can see that whenever that gasoline versus naphtha spread widens or moves particularly strongly, then that will first have an impact on E10, which is why the fact that we have a relatively wide E10, a relatively wide gas nap spread at the moment runs slightly counter to the fact that E10 is trading at a premium to the swap at the moment, to the E5 swap. So we're seeing, therefore, in the bottom right chart here, a positive E10 blend margin. So the E10 is currently looking like it's a particularly an attractive option for gasoline blenders in ARA, as they can essentially pick up components, blend E10, and sell it into the barge market for a profit. Looking into next year, we see some signs that these historically wide gasoline naphtha spreads of the last few years may continue to narrow, and so at the edge, we might see that would be reducing that E10 blend margin that we've seen over recent years. As a final note on this, actually, whenever we see this E10 blend margin open, it tends to be a particularly bearish signal for the underlying EBOB swap. So also it's E10 that's being blended and supplied into the market, but it's then the E5 swap which tends to feel a lot of that pressure. Looking forward to 2025, unless Saket, you have any feelings on any of that.
Hi, Philip, and hello, everyone. I'd like to extend my personal welcome to those of you who joined today's webinar. Yeah, there's a lot of interesting themes that you picked up there. I mean, I guess starting with the East, I was having a look at some of the cargo shipping data, and I think on a quarterly basis, gasoline and/or component shipments from AG to west of Suez in Q4 this year are scheduled to be at their quarterly lowest since about 2017. Now, of course, we're only about 10 days into December, and so the numbers could change, but I think that very much supports your story of fairly tight east of Suez market. And it's interesting. I remember if you cast your mind as far back as 2016, thanks to tax loopholes in China, there were huge amounts of mixed aromatics heading from ARA to the east of Suez, which was quite an interesting arbitrage. But I think as a result of some policy changes in China, we no longer see those kind of flows as much as we did before. And I was also having a look at some of the trade data for the premium unleaded barges in the market, and the data for November, and so transactions for premium unleaded 10 ppm barges in the end of day trading window for the month of November were at the lowest since July. And as you say, there's typically a relationship between traded activity for this grade in the window and people looking to price cargoes into West Africa. So perhaps some relationship there between what's going on in that market and the pickup finally of gasoline coming out of Dangote, which I can see you're about to dive right into.
Indeed. And actually, it was interesting that you mentioned the Chinese policy change back in 2016, 2017. It's again a Chinese policy change, this time on export tax rebates, which I think are helping to tighten a lot of the east of Suez market now, with lower Chinese gasoline exports over the last, November may have been high as refiners front ran some of those changes, but now we're into December, and certainly for the first part of next year, we expect lower Chinese gasoline exports, which is helping to support this east-west move higher, and in turn, as you say, effectively blocking out any of that AG gasoline from moving into the Atlantic Basin. So that moves in nicely to the fact that we should then be seeing, as we move into Q1, without any of that kind of marginal resupply from east to west, and with a potentially larger than recently seen pull from west to east, that we can move into then maybe the springtime in the Atlantic Basin in a much more constructive inventory situation than we may have had in recent years. I mentioned here crude intake in Mexico was lower in October. There are kind of plans, obviously, for that to ramp up with Dos Bocas, but there always seem to be challenges with Mexican crude intake running higher, so a kind of a question mark over that. For Dangote, because obviously everybody's interested in that, it looks as though the latest news is that it appeared to be overcoming some of those initial political or commercial hurdles in terms of supplying the domestic market. The local marketers have had a bit of a sit down essentially, and been told to take more of what Dangote is producing. But it does look as though on a continual basis we'll be seeing more of those higher quality barrels that come out of Dangote entering into the seaborne market, which can have some interesting dynamics as we go through later into 2025, especially in the summer, that we may even see some pressure or some kind of competition from some WAF barrels into Pad 1 versus ARA, and maybe we kind of have a bit of a circle there where we still get those ARA components moving south, and then maybe some of the Dangote stuff moving transatlantic. Otherwise, if we focus on European market, it looks as though, as I said, the E10 blend margin remains open in December, but is very thoroughly closed through Q1, which would typically be a relatively supportive moment for paper, because it looks as though, and we see the E5 blend margin is also closed, so it looks as though there's a good export pull now, both east and west, for European barrels. So European components look as though they have good homes to go into, and it doesn't look as though much of that, when we move into Q1, would be going into supplying the barge markets. So we have a relatively constructive view for at least Q1 EBOB. And as I mentioned before, especially if those Chinese exports remain low and we have a tighter east of Suez balance, then that strength essentially is liable to filter into the west of Suez as well as we move through. I think that was everything that I had to say, unless there's any questions on that. I'm looking forward to hearing what you have to say as well, Saket.
Maybe I could pose a question, Philip, and that's to do with the impact of refinery closures and turnarounds next year. If going, I guess, from Europe across to Asia, we have Grangemouth shutting next year. Scotland's only refinery. Total have announced they're doing some major turnaround work at the Antwerp refinery, including at one of the FCC units next year. And then, of course, LyondellBasell have announced they're shutting their Houston refinery, which I believe means something like 100 KBD less of gasoline that either coming into the Gulf Coast or going up the Colonial Pipeline. Fundamentally, do you see the refinery situation vis-a-vis shutdowns, turnarounds, and so on being supportive for the gasoline complex going into the new year?
Yeah, certainly the list of closures or kind of either closures which were expected but have maybe been brought forward, or now the confirmed ones have been ramping up. I think we're somewhere near kind of 600 KBD of capacity that we see coming out of the market through 2025. So that will certainly be constructive. The Gunvor setup in Rotterdam is obviously kind of another. It's a relatively small one, but that was effectively a big reformer. So in particular important for gasoline markets and the pricing center in this case. So yeah, actually, it was. As recently as kind of August or September, when we were maybe getting a little bit bearish looking into the winter, and we have Dangote coming on and we have Dos Bocas coming on, and refinery margins weren't fantastic, but I mean we're getting increasingly supportive for 2025, both on the crude balance looks exceedingly long, and therefore kind of a total liquids balance looks very long, and so it's difficult to get too excited. But for gasoline, kind of taken in isolation, I think we can certainly look to have a slightly more supportive year than 2024, all else being equal.
It's very interesting. Thank you. I shall now request control of the slides and pivot the discussion towards the impact of all of this on benchmarks and try and situate where we are from a benchmark perspective, because of course all of these molecules are moving, whether it's by pipeline or barge or tanker around the world, and they all require liquid benchmarks against which to trade, and that's the business that we are in General Index. Most people are aware that across Europe there are two main gasoline grades for the blend stock used to blend up to the finished grade that people access at the pump, and that's Eurobob E5 and Eurobob E10. In other words, the blend stock suitable for blending with ethanol to make E5 or E10 gasoline. And because of legislation over the course of many years across European countries, in order to support the energy transition, there has been more and more uptake of E10 gasoline across Europe. And so now over 20 countries across Europe have over the years either moved to E10 as their standard grade at the pump or have made it available at the pump alongside the lower ethanol grade. Some of the key moments in this transition were Belgium moving in 2017, followed by the Netherlands in 2019. And at the time, there was thinking that, well, with all of the ARA terminals in E10 countries, does this represent a key moment in the transition from E5 to E10? And then over the course of the pandemic and beyond that, that transition continued to gather pace with the UK moving in 2021. In France right now, something like 80% of retail stations offer E10 gasoline. So across much of Northwest Europe, it's quite a strong E10 picture, at least superficially. But then if you look into it in detail, you not only notice that the Mediterranean remains quite solidly E5, but in Germany, where E10 is widely available, nonetheless, take-up remains well short of a majority of domestic consumption. Official data puts consumption at somewhere between 25 and 30% for E10. And based on our conversations with people in the market, a move in Germany towards E10 as the standard grade or the majority consumption grade of gasoline is a key requirement for the market as a whole to move across to E10 as the benchmark grade, which will have implications, as we'll see in a moment. Pardon me, there's been a slightly sticky slide control situation. The movement from E5 to E10 across many countries in Northwest Europe, despite what I was just saying about the benchmark remaining on E5, has nonetheless started to be visible in Eurobob barge spot market activity. And so you can see on this chart here, these are monthly volumes in 1,000 metric tons of all-day barges traded in the spot market. And from the first trades on E10 non-oxy that we saw back at the start of 2018, I recall, I think it was the Canadian refiner Irving who was one of the very first counterparties on this grade. There's been a slow but steady increase, particularly around 2019, 2020. So much so that in more recent years, it's not been unusual to see months where we see more E10 trading rather than E5. So notwithstanding the last couple of months where we've seen a surge of activity on the E5, nonetheless, the two are very much in contention in any given month for the maximum volume being traded. That is not, however, what we see in the derivatives market. I put together this chart based on publicly available data on ICE cleared instruments. And as you can see over here, really there's no contest. Only about 3% of all the open interest of Eurobob related derivatives on ICE relate to E10 instrument. And so the market preference on the paper side is still very much for E5, despite what you saw on the previous slide of more and more liquidity on the spot barges for E10. Based on our observations of trading activity, we see the preference of market participants is to lock in the E10 E5 spread on the paper at the start of the trading day. But on the whole, I think based on the current uptake, we really don't see any significant increase in E10 derivatives activity going into next year. One of the interesting things that has happened in the course of this year from a standpoint of benchmarks has been a methodology change at the start of the year for the E5 grade in order to help encourage greater usage of E10 in gasoline trading, where E5 is now assessed as a differential to E10. And the impact of this, of course, has been a reduction, as you can see in the chart, of volatility. The chart over here shows the premium of E5 to E10. Now, to some extent, of course, we must recognize that a lot of the volatility that we see prior to 2024 is reflective of the fact that this is an all-day cash market, and so therefore you can have trades at 9:03 in the morning and 5:28 in the evening, and sharp moves intraday in the flat price will have significant effects on the print. But now that E5 is being tied to E10 in a more direct mathematical way, methodologically, we're seeing much less volatility. And looking at the two grades as they trade as differentials to the front month E5 swap, what's been more noteworthy recently has been E5 moving into a discount to the front month swap. And I was thinking of this chart during Phillip's comments earlier when he was talking about the arbitrage in relation to the AG and the tighter East of Suez market, and indeed the open arbitrages to places like Saudi Arabia and others could very well be driving behind one of the driving factors behind this. And again, looking at the shipping data, I think there's been definitely a significant pickup in gasoline exports to Saudi, and so the fact that E5 is now a discount to the swap could be having direct effects in the international arbitrages. Phillip, do you think that's likely?
I think that's fair. Yeah, I think as we said, the demand for these should now pick up, but it's only emerging. Well, it's emerging for two reasons. It's emerging simply because the paper spread between EBOB and Sing 92 has moved to such an extent that that is now positive, and that will anyway try to pull barrels out of Europe. It's been helped though when we break down it and look at the kind of grade by grade situation. It's been helped by the fact that it can pull out, as we said, some of these E5 barges to pull those into the finished grade.
So we may very well see in the weeks ahead that blue line creeping back up again into positive territory. So
that would, yep.
Let's keep an eye out for that. I'd like to talk, if I may, a little bit about what it is that we are trying to do in all of this in gasoline pricing. And so EUROBOB has a special place in GX history. It was the very first price assessment that we launched back in the spring of 2020, not long after the company was founded. And the way in which we go about EUROBOB typifies our modus operandi here at General Index, which is to move away from the legacy manual, human-led, journalism-based methodologies and calculation processes to a more data and tech-led approach. The result of which is numbers that have been validated by the market and that people trust, and people can trade with greater conviction because they have more reliability and certainty on the methodologies that are being used. For every index or price assessment that we have, we produce fact sheets with flowcharts that provide full specifications on the methodology being used to assess the grade in question. And the underlying motivation behind all of this is to try and avoid the so-called black box problem. We never want the end user to be surprised by the calculation that we use to generate a price assessment on any given day. And so fundamentally, under a given set of market conditions, GX will always use a consistent calculation logic to arrive at a price assessment. And I think the value of this has been proven, particularly during certain trading periods, such as periods of low liquidity, or during the twice annual transition between summer grade and winter grade on gasoline. We can say that we have had a consistent and robust methodology. We also have started for quite some time now assessing the front month swap at 4:30 London time, receiving direct submissions from all the major participants in the paper market, the major brokers, that is. And the swap assessment is also starting to gain some visibility and traction in the market. I'd like to take a moment to highlight the robust nature of our compliance approach. The gentleman that you see over here on the screen is our Head of Compliance, Jonathan Hill, who was previously with the Financial Conduct Authority, a key author of the IOSCO principles for price reporting agencies, which govern so much of our work. We are authorized by the FCA as a benchmark administrator and are compliant with UK and EU benchmark regulations. And so we take compliance processes very seriously at this company. A data review group exists to be able to adjudicate if there are pieces of input data that may or may not meet methodological specification, or to provide guidelines on how to handle a novel market situation, and other groups that help to handle formal complaints and ensure a strong stewardship of the benchmark. And so, having built up this approach, a compliant data and tech-led approach with a robust methodology, our data has been analyzed and validated by the market. Our Eurobob prices are now being used for a variety of internal use functions in the industry, including P&L reporting, mark-to-market, inventory valuation. We're being used in spot and term trading, and the full adoption of our data could generate significant cost savings for the energy industry. And that brings us to the news that we wished to highlight during this webinar, which is the listing of new futures contracts settling against our Eurobob E5 Oxy number. There have been participants in the market who had already started using our E5 Oxy number in trading and wish to have a matching hedging instrument for price risk management purposes. Well, now these instruments exist, as you can see on the screen. 3 new contracts that have been ready to trade since Monday, December 9th. Brokers are very happy to create legs if people wish to trade cracks and ARBs and spreads, and now exposure to GX E5 physical can therefore be perfectly hedged. I'd also like to give a quick plug to a new user interface that we are currently developing and will be debuting to the market shortly, which will give all market participants or all interested parties instantaneous and easy access to all of our gasoline pricing, not just in Europe, but in other regions as well. So although our data is available through all the main platforms and aggregators and ETRM systems via API and so on, this is yet another method, and a very easy method to get data across into your systems, and will allow people to very quickly use data for market analysis purposes, for risk analysis purposes, verification of invoice prices, and so on. This last slide is titled Panoply. It's a bit of an inside joke, but we were trying to come up with one word to explain the fact that what we have built up over the last 5 years is a comprehensive gasoline price offering to the industry. We have a robust technology layer in place to ingest raw data, deduplicate it, perform hygiene checks, run methodologies automatically. Our methodological approach is transparent and consistent and validated by the market as best in class. As I was mentioning earlier, our data is very widely available indeed. We already have market participants trading on our numbers in both spot and for term contracts. And the final piece of the puzzle is the futures contracts that went live on the ICE exchange on Monday, which will allow people to trade more with confidence, knowing that they have the price risk management tools that they need. And so to hammer home the point, as if it wasn't clear enough already, we are ready and waiting to seize benchmark stewardship on Eurobob gasoline in 2025. And with that, just a minute to go before 3:30, I will finish up and hand over to Andy for Q&A.
Fantastic. Thank you very much, Philip and Saket. We will now open the floor to any questions you may have. If we run out of time to answer all of your questions, we will certainly make a point to respond to you via email afterwards. Again, please use the Q&A function at the bottom of your screens to ask any questions. I can see that while Philip and Saket have been presenting, we've had some come in. So I think this one's to Philip. Is the 2025 gasoline market only being supported by a tighter EOS balance, or are there also some reasons for optimism in the West?
A very good question. I think we've anyway touched on it a little bit when we talked about refinery closures in the West. And I think probably maybe the one thing that I didn't mention and should be pointed out is that actually gasoline demand in Europe looks to be very strong. It's we talk about, obviously we've certainly plateaued on distillate demand in Europe, but gasoline demand growth this year has been very supportive. And as we continue to see fuel switching, then that there's no reason that can't continue into next year as well.
Fantastic. Thank you, Philip. Another question, just to follow up to above, will the wider MTBE availability widen in the E5, E10?
Yes, sorry, this was a question which came in about Nigeria going non-oxy. And how that would impact MTBE balances. I just had a quick look on our platform at least, and because I didn't remember MTBE being a huge kind of component in WAF grades historically. I may be wrong on that, but certainly given current pricing, we don't have MTBE going into the Nigeria grades for export. So at least in the short term, that shouldn't have too big of an impact on MTBE balances. I think the typical kind of outlets for MTBE into European origin gasoline exports should continue. So from our current standpoint, not a huge impact on MTBE balances.
So thank you, Philip. Another question, high octane component premia were lower in 2024 than in 2022-23. Do you expect them to trade lower again in 2025?
I think we were saying that maybe we have a slightly narrower gas nap into 2025, just on eventually the promised naphtha demand from petchems is going to kick off, and we will get these tighter naphtha balances. If that does happen, then we would see obviously a little bit more pressure on those higher octane components. But overall, it would seem as though with the closures that we have and the generally tighter balance, then that's going to be a pressure on obviously both quantity and quality potentially. So yeah, a return to, or a situation where we have well supported high octane components is perfectly possible in the next year.
Great, thank you. Possibly a question for Saket. How long will we see the disconnect between the physical market increasingly trading E10 barges and the paper market overwhelmingly trading E5?
This is indeed the million-dollar question, and I think there are many people in the market who were expecting the two to move in sync from the start of this year, prompted by the methodology change on the E5 and linking it to E10. Now, that did not turn out to be the case, and we'd heard from different stakeholders in the market that a combination of the German factor, the Mediterranean factor, and the fungibility of barrels, that E5 continue to remain the more useful price reference for many people in the market. It's also worth remembering that there is a cascading effect of benchmark usages from the refinery down the value chain, and so any change that happens at a high level can often take time to filter down through. I was having a look at the GX E5 Oxy contracts that went live on ICE on Monday, and on the ICE screen there are tenors that go out to DEC 28. Now, if you ask me, do I think that by DEC 28 the bulk of derivatives open interest will still be sitting on E5 interest, on E5 contracts? I would like to think that the market probably would have shifted in that time frame as we continue to see the E10 share of consumption in Europe grow. It's interesting as well. Philip just mentioned Nigeria. moving to non-oxy. The US, of course, has long pushed back against MTBE and its own gasoline. And so I think the routes and the outlets for E5 oxy over a long period of time will continue to reduce, and therefore E10 over a long period of time will make sense as the more useful price reference.
Excellent. Thank you, Saket. Possibly time for one or two more questions. This one is for Philip. What impact could US tariffs have on the gasoline market?
I think the first thing to say is we need to take any talk about tariffs at the moment still with a pretty large pinch of salt. Obviously, Trump will typically escalate to de-escalate, and there's already signs that maybe that won't come into effect. The very short answer is if there are tariffs on crude imports, that is devastating for the US refining industry, and so will obviously therefore be a positive to the wider or to the global gasoline market, because it will be exporting less and importing more. If it's just on products, then we would see a wider TA arb. So arb would need to price lower essentially to get over those tariffs. It's either way, it wouldn't be particularly positive to the US consumer, but there are possibilities where it's actually very or could be quite beneficial to a European refiner.
I think given the political sensitivities around prices at the pump in the US, it's hard to imagine that someone like Donald Trump, who you could say has his finger on the pulse of the popular mood, would do anything to risk high petrol prices. It is widely considered almost like the third rail of American politics, and so it seems difficult to imagine that he could impose tariffs which would significantly raise or noticeably raise prices at the pump, given that the cost of living crisis was one of the top election issues in this year. But it's possible, maybe Philip, that Europeans, by perhaps agreeing to, for example, buy more US LNG or something along those lines, could help to cut some sort of deal which would create a gap for European refiners to continue selling gasoline to the US, for example.
Yeah, definitely. There will be a deal to be found in there somewhere. We did briefly have that discussion on our own podcast not too long ago about pump prices. That was actually my point, and my colleague pointed out that he's got at least 2 years until the midterms and 4 years until any kind of presidential re-election. If not for himself, then for the Republicans at least. So maybe you would have a little bit of time where he could absorb some slightly higher pump prices if it was deemed worth it in the end for the good trade deals. But no, I kind of agree that it would be very risky to start touching US pump prices.
So I guess to kind of maybe summarize some of the themes that we discussed today, it sounds like there's good grounds for optimism for gasoline cracks in the overall gasoline complex for next year. I suppose there's a lot hanging on Dangote and its ability to increase gasoline production for next year, given that we're going to see less coming out of the US and Europe because of all of the closures and turnarounds that we discussed earlier. Keeping close eyes on the arbitrage between East and West and how that changes going into the new year. And then finally, a little bit closer to home, obviously we have new contracts in play on ICE, and so it'll be interesting to see open interest developing on these instruments, and whether the changes in the market also are reflected in changes in benchmark activities as well. Unless any final thoughts, Philip, maybe we'll hand back to Andy.
Good summary. Thank you for inviting me on.
Our pleasure. Thank you.
Thank you. Thanks very much, Phillip and Saket. That indeed brings an end to the question and answer session and the webinar. Thank you to all of our attendees for coming along. We hope that you found it informative and useful. Once again, the webinar was recorded and will be made available for you to replay afterwards. Once again, thank you for joining General Index and Sparta.